Hey everyone, today I'm going to be talking about how the stock market can be up when the economy is doing so poorly. And also, we're going to get into what it means to be a market cap weighted index. So recently the economy has really been suffering because of the pandemic and the associated shutdowns. But the media has also been talking about how great the stock market has been doing, and it has been setting records since the market bottom on March 23rd. So how can this be so? First of all, the stock market is what we call a leading indicator. That means it's forward looking, it's looking into the future. The stock market is never a reflection of our current economy, whether we're in a pandemic or not. The other thing to think about in terms of how the stock market can be up so much during this pandemic is that the stock market, which in general, when we say the stock market right today, and the media in general is usually talking about the S&P 500. The S&P 500 is the 500 largest companies in the United States. So the S&P 500 is what we call a market cap weighted index. And in a market cap weighted index, the larger companies in the market account for a larger share of the index. In this case, the S&P 500. So if we look at what's happened recently during the shutdown, we see certain areas of the economy were hit especially hard. For example, retail, especially brick and mortar retail, tourism, oil and gas, airlines, all of these stocks did go down. But in contrast, some sectors of the economy did really well during the shutdown, like technology companies. So with a lot of people moving to work from home, a lot of this technology was in demand, both in the United States and abroad. So if you look at the figure on our blog post, you can see different numbers from different sectors, and you can see that these top technology companies, the top 10 companies, gained more than 37% this year. That's through July 31st. And because these companies were already big to begin with, they take up a disproportionate share of the market. So in the S&P, the top 10 companies account for almost 25% of the market. So in this demonstration I'm doing today, I'm showing you here that Amazon and Apple and big tech, they're like this tennis ball. And in contrast, department stores, which is a ping pong ball, they're down 63% through July 31st. A huge number. But they're a much smaller percentage of the index. They're actually only 0.01% weight of the market. So when we see a change in the stock price of department stores, that's not going to have a big ripple effect across the broader market because it's such a small percentage. But we have a big change like we saw in big tech, which grew so much, like in Apple, Amazon, Microsoft. All of them did very well over the past several months during the lockdown. So we see a very big splash. And that big change caused by these big tech companies has a much bigger impact on the broader market than the much smaller change we see from other areas of the economy. So that's why everyone's saying is the market is up. And I'll leave it as a thought exercise for everyone at home is that, what would have happened if we saw these top 10 big tech companies fall by a lot? How would that have affected the broader market? So thank you everyone for tuning in today. I hope you found this video helpful. If you did, please let us know in the comments. We love feedback, and you can also subscribe to get notified of future videos. Thank you.